Well, the force is strong at the box office, certainly, but massive Star Wars ticket sales, not enough to lift the price of Disney stock. Shares have fallen for 3 straight sessions as investors are somewhat concerned about the pressure cord cutting is putting on ESPN. Joining us right now is Cumberland Advisors Chairman and Chief Investment Officer David Kotok. David, good to see you. Thanks so much for joining us.
It's nice to be here.
What's your take on Disney? I mean, you know, you would think that the stock is going to do really well, given that, okay, $538 million globally for the weekend, Star Wars alone.
I'm a Star Wars fan.
Me too.
You know, I remember Yoda personally. But the question is not Star Wars. The question is consumer discretionary spending expanding, new housing. Are we going to have new cable installations? What's the growth side of consumer spending? Yeah. That's what Disney is about. It hasn't gotten robust. We had the energy price drop. We predicted all this spending out of the consumer. Consumers got scared. They saved money. We haven't seen it yet. Are we going to see it? I think yes, that gets better. Well, but we haven't seen it yet.
We were just talking about that with the price of oil, because all the savings at the gasoline pump still hasn't filtered its way into the economy, has it?
No. I mean, gasoline was close to $4. Now it's $2.
Yeah.
What happened to the money? It's interesting because every penny is about $1.25 billion in spending capacity in a year in the United States, and it hasn't translated. It's translated instead to savings. It's not being spent.
5.6% savings rate, I think, right now for the consumer.
Yeah, yeah, and you know, so that is, as we discussed, that is going to help the consumer. But you know, when you look at Disney, I think the story is a lot less Star Wars and a lot more ESPN, which is their biggest franchise. But it's funny. This morning, BTIG is out with a report on Disney. They cut it to sell.
Oh, wow.
They sell the stock. At the same time, they went to sell. Same time, JP Morgan is out reaffirming their buy recommendation on the stock. So you get both sides of the story here. But for me, looking at Disney, this is a global franchise that I want to own at some point. I don't want to jump in and buy the stock here at 106 because the momentum is going down. I want to hear from Disney how they're going to replace the dollars that were coming from ESPN.
Explain the ESPN problem, Mike. I mean, people are basically saying, look, I'm not going to pay all this money for all of these channels, but explain cord cutting.
So we don't really know yet what the a la carte pricing would be for ESPN. So right now, you go out, you get a cable box, and you need sports. People getting cable because that's their only way to get sports.
So they pay for everything.
Have to pay for everything, and a big portion of that is ESPN. So people said forever ESPN will always have that revenue because people are always going to want to watch sports.
Yeah.
Now all of a sudden we're hearing different takes that people are cutting the cord anyway, talking about watching sports online versus paying for it. That's the bearish side of Disney.
So that's really what's happening to the stock over the near term.
Over the near term. Dynamism requires change. You used the word. People always thought. Take the word always out. There is no always in developing markets and economics. Never. And dynamism will hit Disney too. I'm with you. A long-term fan. Not today.
Let's talk broader economy for a moment. We got the GDP number out this morning. David, what are your expectations? Where are we in terms of the economy relative to investing in the stock market?
We are in continuing slow growth. The old 3% number is a 2% number, and it's going to take a while to get to a 3% number. I am optimistic about housing. Housing is starting to appear to strengthen, and that could be a trend. We get strengthening housing. We have the household formation. We will start to see the economic growth pick up in the United States. It looks like it's coming. The overhang of housing is over. That's bullish.
Yeah.
So GDP, we said it, we talked about it once before on the show. You can't buy and sell GDP. You have to buy and sell the participants in the GDP.
Yeah, but you also have durable goods out. Now, durable goods is an indicator of sort of the industrial side of the economy, and we know, Morgan, that, you know, the industrial side of the economy, manufacturing, has been under real pressure. We'll see what the durable goods number says, but that's also out.
Absolutely, and I think the point that you made earlier about American households not spending the money that they're saving from the gas pump and other places, I think that reflects, whether it's that or a manufacturer, reflects continued lack of confidence in U.S. leadership in the U.S. economy.
You also have weakness in the oil patch. So you got 12 states which are getting contracted in crunching. Those states are suffering.
And there's a knock-on effect to that. I've been talking about that a lot here. I'm worried about the price of oil as it relates to broader economic job cuts.
Yeah, I think that's valid. In states like North Dakota, which boomed and never had a financial crisis, it's going the other way. So we do have enough of the region of the country being impacted by energy to slow things down.
Right. Yep. I think your point, that as many negatives there are with job cuts in the oil patch, I think there are also positives there to outweigh that. You know, I think the trickle down into the overall economy will create more hiring. So I think that will balance itself out. I think a big key to watch is stock repurchases. A lot of companies in there buying back. So you can say we don't have earnings expansion. True, but we do have a reduction in the number of shares, which acts like earnings expansion.
Yeah,
so
when they keep buying it back, they lessen the float, as they call it.
Exactly.
Yeah. Real quick, David, 2016, what's your assessment? What do you expect?
The biggest thing for me, and I think 2016 is a good year, but in the stock market, single digit, high single digit, nothing more exciting than that because of uncertainties, unless we have a global cooling. That's what we need to get the energy prices back. We're not going to have
So
that.
where do you put your money if you're not expecting a great stock market?
There are picks in sectors. We only do ETFs. One I like, for example, is the specialty equipment in the healthcare sector. IHI is the symbol. It's an ETF that captures healthcare equipping, the kinds of devices which are needed as part of the package. That's a good idea. We own it in our portfolios.
We'll leave it there. Dave, good to have you on the program.
Nice to see you. Happy holidays.
Happy holidays to you. David Kotok, Cumberland Advisors Chairman and Chief Investment Officer. Merry Christmas. Happy holidays to you.
Bet.
More